Well, good morning and welcome to Financial Accounting. As always, we start with a look at our calendar, and we should be finishing up Chapter 12 today. So assuming we do that, the Chapter 12 exercises should be submitted for grading by the end of the day. There is a possibility we may not finish. We have quite a bit to get through. If we don't finish, we'll just push this. We'll just push the exercises to Wednesday, so no worries there. Then the Chapter 12 problem should be submitted on Wednesday, and on Wednesday we will start Chapter 13 on the cash flow statement. We'll finish that on May 2nd, cover Chapter 14 on May 4th and the 9th, and the 9th is the last regular class day where we'll be covering new material. So the 11th is officially a class day, but there won't be a formal class. It will be kind of like our drop-in review session for that week. You are not required to come to class on Zoom or on campus. If you have questions, though, you are welcome either place to get those questions answered. I'll open the Zoom link, as always, at 9 o'clock and see who might be there. If you don't have any questions or don't have anything you want to talk about on that day, you don't need to attend. Friday, May 13th is the official last day of the semester, and so that will be the last day to submit any outstanding work, and including the last exam, Chapter 12, 13, and 14 are on that exam, and then the last piece of the project as well. Any questions about any of that? Okay. We don't have a drop-in review session scheduled yet for this week. I am completely unavailable on Friday, so I'm looking at Thursday. I have some limited time available on Thursday, but what I would ask is if you're interested in attending a review session on Thursday, please just send me a note to let me know that. I guess if we were meeting on Thursday, we would cover probably the Chapter 12 problem if you had questions on that. But like I said, if you do want to schedule something on Thursday, I have things throughout the day, but I have some free time, I think. Maybe mid-afternoon. So let me know if you are interested in scheduling that. If there aren't any questions, then we are going to go to exercise 1 in the Chapter 12 exercises. We had started this together, but we ran out of time. I had suggested you could try year 3 and 4 on your own if you wanted to do that. I'm going to do a brief recap of what we've already done, and then we'll finish up this exercise together. So remember, we were dealing with a company that has both preferred and common stock outstanding. The preferred stock was cumulative. And so we saw that in the first year when dividends were declared and those dividends were not sufficient to cover the full dividend for the preferred stockholder, some of those dividends carried over what we call dividends in arrears. And so they're not a liability of the company, but they would be disclosed in the notes to the financial statements to let people know, hey, we haven't actually met our full obligation to the preferred stockholders. That's one of the preferences that preferred stockholders have, is in receipt of dividends, they receive their full dividend before anything goes to the common stockholders, but then common stockholders get whatever's left. So we had done this together in class last week, but I'm going to redo it just here on the screen so we can see what the full dividend is for those preferred stockholders. 60,000 shares, God bless you. 60,000 shares of cumulative preferred stock. It is 2%. That's the stated dividend rate, and 2% of what? Of the par value. So each share would get 2% of the $60 or $1.20 each year that enough dividends are declared. Remember, it is up to the board of directors to decide whether to pay dividends at all. But they would, when those dividends are declared, the first $1.20 per outstanding common share, or excuse me, preferred share, not common share. And then there are 60,000 preferred shares outstanding. So the full dividend for the preferred stockholders would be $72,000. So in the first year, they declared only 51,000. That meant that 21, can't do math on a Monday morning, $21,000 in dividends and arrears carried over to year two. In year two, then, they paid the 21,000 that had carried over from year one as dividends and arrears, plus the 72,000 that was for year two's full dividend. So a total of $93,000 was paid to the preferred shareholders. That equates to $1.55 per share. And then we move on to year three. But any questions about what we had done up to that point? Everybody feel comfortable with what we did? So in year three, they have no dividends in arrears. So when they declare $82,000 in dividends for year three, what that means is the first 72,000 would go to the preferred stockholders. They would receive their full $1.20 per share. And then the remaining 9,000 would be left, would be the residual for the common shareholders. And there were 300,000 shares of common stock available or outstanding. So the $9,000 split among the 300,000 shares of common stock works out to be 3 cents per share. Then finally in year four, they declared $120,000 in dividends. The first 72,000 pays the full $1.20 to the preferred stockholders. And again, the common stockholders get the residual, or what is left, $48,000 in total. For the common stockholders, that would be shared equally among the 300,000 shares. For a per share dividend of 16 cents. And so we pointed out in class last time, why would you want the common stock when you look at the preferred stock and see not only do they get their dividends first, but they also get, at least in these first 4 years, substantially more than the common shareholders do. And so what we mentioned about that was there's probably not an equal amount or equal market value for the preferred and the common stock. The preferred stock probably costs more on the open market than does the common stock. And so we have to look at the return on those shares. And so not only do we have the dividends per share here, per share, but we'd also want to look at the dividend as a percent of the market value. So that gives us one piece of information. The preferred stock is definitely less risky because it has preference over the common stock, but those are not voting shares. And we also have a cap of, in this case, 2% on the earnings. So 2%, that $1.20 will remain the dividend for those preferred shares forever. It's never going to be more than that. Where the common stock, you can see, is variable and more risky, but as the company continues to grow, the dividends may also continue to grow. And so in year 4, the common stock received 16 cents per share as dividends. Check marks in there. Any questions then about dividends, dividend payments? These are all cash dividends we've looked at now. In exercise 5, we saw the 3 important dates. The dividend declaration date, when the board of directors says, hey, we're going to pay these dividends, then several weeks, maybe to a couple months later, we have the date of record, which determines who receives those dividends. And then again, several weeks, maybe a couple months later, we have the dividend payment date. And that's when the dividend checks are actually mailed. Any questions about cash dividends? Okay, if not, I'm going to jump over to our next exercise. Excuse me. So our next exercise is going to be on stock dividends, and I'm going to go to the PowerPoint just for a minute to talk about those. You should read additionally in your book what the book has to say about stock dividends. Let's go to the PowerPoint for a brief review of that. So stock dividends can take one of 3 forms. And we have small stock dividends where the stock dividend is up to 25%. We have large stock dividends, which would be between 25% up to 100%, but not including, would have to be less than 100. And then we have stock splits, which are a little bit different. So we'll talk about those separately. So why would a company issue a stock dividend at all? Well, remember we said last week that it is the board of directors that is responsible for determining dividend policy, and that there's no requirement that dividends be paid at all. And some companies, as a matter of course, do not pay dividends. We also talked last week briefly about why some investors might not want to receive dividends. So a measure of dividends yield, which I already mentioned, it didn't say that name, the ratio of the dividend to the stock price. Some investors want a high dividend yield, and some investors might want a dividend yield of 0 because it's a taxable event, because they want the company to keep their cash and continue to earn more money for them. Remember, I said the only restriction related to the board of directors declaring a dividend is if they're going to declare a cash dividend, they have to have the cash available to pay it. They can't declare a dividend if they don't have the cash to pay it. So when a company has a history of paying dividends, maybe they pay a dividend every year or every quarter, and maybe it's the same, just as an example, maybe they pay 20 cents a quarter and they have for 50 years or even 10 years. Maybe they have a habit, a track record of increasing their dividend every quarter. So maybe it was 20 cents and it was 21 and 22 or 23, it keeps going up. That dividend pattern, that history, sends a signal to the market, sends a signal to the stock market about what the board of directors thinks about the company. Paying a high regular dividend says something about the point that the company is in their business life cycle. Having a pattern of increasing dividends sends a positive signal to the market about the future of the company. It's growing, it's doing better, it's more profitable, we have more money, more returns to share with our investors. And so if there's a requirement that companies have the cash available to declare a dividend, the company may want to declare a dividend to send that positive signal to the market, but if they don't have the cash available, that's one way that the company, the board of directors, can send that positive signal without actually spending cash. Maybe they have some other use profitable investment for that cash. Maybe they're just having a cash flow problem and they don't want to free up that cash to pay the dividend. And so instead, the company can choose to declare a stock dividend. Now, as you can see on this slide, stock dividends are typically only declared on common stock and issued to common stockholders. As I said, what would happen is the company, the board of directors would decide how big a stock dividend they want to declare. And it could be, say, a 10% stock dividend. So if you have 10 shares of, you had 10 shares prior to the declaration and distribution of that stock dividend, now you'd have 11. If you only had one share, you'd now have 1.1. You'd have 1/10 of another share. A small stock dividend that is up to 25%, the assumption is based on just generic economics, just common economics, is if we put more stock in the marketplace without actually changing the company, if we just distribute more stock, think about what this would look like on the, put this on the screen. Fundamental accounting equation. Assets equals liabilities plus, plus stockholders' equity. So here's our fundamental accounting equation. If the company just hands out additional shares of stock, they didn't sell them, they don't get any cash in exchange, they've taken extra shares that they're authorized to distribute or to sell and just given them away. That's in simple terms, that's what a stock dividend is. You have some of our stock here, have a little bit more. So did anything happen to change the assets of the company? No. Unlike when we sell stock and we have the cash, so our cash goes up and the equity also goes up, nothing happens to affect our cash if we just give away the stock. Does anything happen to our liabilities when we give away stock? Again, no, nothing has changed. So the only thing that changes when we issue a stock dividend is something within this stockholders' equity accounts. The stockholders' equity section still has the same total dollar amount. We know that must be true because we have an equation here on the screen and we just said assets and liabilities don't change. So in order to keep that equation in balance, we know also that the total of our stockholders' equity does not change. So what does change? It's the split, it's the dollar amounts in the two pieces that make up our stockholders' equity. We have our contributed or paid in capital, and we have retained earnings. And in a stock dividend, we move some of that value out of retained earnings and into contributed capital. In total, our stockholders' equity remains unchanged because our assets and liabilities remain unchanged. A small stock dividend then, as I said, up to 25% is considered a small stock dividend. And in a small stock dividend, we recognize that putting more shares of stock out in the public without actually changing anything in the company actually devalues those shares, right? So if the share was worth $10 before, and then all of a sudden there's 10% more shares, we would expect that stock price to fall to something in the range of $9 a share, right? It's going to lose some value because we didn't create any new value for the company, but we're just sharing it among more shares. Same exact shareholders we had before, but every one of them owns, in my example, 10% more shares than they did before. But each one of those shares should be worth about 10% less. Does that make sense to everybody? See where we are so far? Okay. So with a small stock dividend, less than 25%, we know in reality the stock price is going to be affected, but we assume that that impact is going to be minimal. And so we use, as you can see here in the final bullet point on this slide, we use the fair market value, which is the price on the open market of those shares, to represent the value of that stock dividend. And that's the amount that we move out of retained earnings and into contributed capital. And we'll see in exercise 6 how that works. If it's a large stock dividend, which is between 25 and 100, up to, but not including 100% dividend, we know now we're putting so many more shares out there. We know that the market price is going to be dramatically impacted. And so if it's a large stock dividend, instead of moving the full market value, we use the par or stated value. And that's the amount we move from retained earnings into contributed capital, just the par value or stated value. Oops. Okay. So, and we'll get to stock splits in a minute. A stock split is 100% or more. So it's basically a stock dividend, but it's a very large amount. So a stock split would be, if it's a 1-to-1, sorry, I should say a 100% stock split, that means you had 1 share, now you have 2. Could be a 3-to-1. So you had 1 share, now you have 3. The purpose of a stock split like that is expressly to lower the price of the stock. So every company has what it considers to be, what it thinks the public considers to be the ideal trading range. In other words, how much should that stock be worth? And so as the company price, the stock price continues to rise, it kind of hits a ceiling. And so the price will not rise, or not rise as quickly as maybe it otherwise would. And so the company institutes a stock split to bring that price down, and then you'll see it rising again. And the data show that that really actually does work that way. Let's go to our next exercise for today, though, and that is exercise 6. So remember, I think everyone who's here today was also here last time. So we did exercises 2 through 5 together last time, and then we jumped back to 1, which we just finished. So now we're on exercise 6. We talked about last class the concept of number of shares authorized. Those are the shares we have permission to sell. Then the number of shares that are issued is how many we actually have sold. In order to declare a stock dividend, remember, for a cash dividend, we said you have to have the cash available. The same thing is true for a stock dividend. You have to have the number of shares available within your authorization in order to declare and distribute a stock dividend. So you have to have enough room within your authorization to issue those new shares. And so we can see for this company, Healthy Life Company, that they have permission or authorization to sell 3 million shares, but they only have issued 2.2 million. So they have an extra 800,000 shares that they can choose to either sell or distribute to their shareholders. We can see that these shares each have a $15 par value. So from what we learned last time, the common stock account is required, must have in there the number of issued shares, 2.2 million, times the par value. So if you were to calculate 2.2 million shares times $15 par, you would discover that the company must have $33 million in the common stock account. We're told that here. They didn't need to tell us that because that must be true. Then again, last class we saw that when we sell the stock for more than its par value, anything beyond the par or stated value is going to get credited or added to that paid-in capital in excess of par. And you can see that the shares that we have sold in the past were sold for $9 million total over the par value. This company's also been around for at least a little while and has been making money. And so they have retained earnings of close to $90 million. The board of directors declared a 5% stock dividend when the market price was $18 a share. That 5% certainly fits our definition of a small stock dividend. And so we're going to use that $18 per share as the value of our dividend. So 5%, 5% of what? Just like with cash dividends, the stock dividend is paid only to the outstanding shares. We assume, because we're not told otherwise, we assume that the 2.2 million shares that have been issued are still outstanding. We'll be talking about maybe even in our a couple exercises from now, we'll talk about what the difference between issued and outstanding is. So for now, we're making the assumption that all of these 2.2 million shares are still outstanding. And so we're going to distribute 5% more shares, or 110,000 shares. 5% of the 2.2 million is 110,000 shares that we're going to distribute as a stock dividend. Take the number of outstanding shares times 5%. That tells us how many shares we're going to distribute for our stock dividend. What's the value of that? Again, we know that this is a small stock dividend, so we're going to use the $18 per share. And so the value for our accounting records, the value of this dividend is $1,980,000. Did we actually create almost $2 million of value for our stockholders? No. But again, it sends that positive signal to the marketplace to say, hey, we believe in our company. We believe our company is going to continue to do well. We believe that by giving you more shares in the company, we are giving you something of value. Now, a 5% stock dividend is not going to have a significant impact on the stock price. We would expect the price to come down a little bit, maybe even 5%. But in general, again, if we're this company, we believe that by giving this stock dividend, we are providing some value to our customers, to our stockholders, not customers. Just like for the cash dividends, the debit side of this journal entry is to record the value of the dividend. In this case, $1,980,000. When it was cash dividends, we debited cash dividends. Now that it's a stock dividend, we debit stock dividends. If this was a large stock dividend between 25 and 100%, rather than using the $18 a share, we would have used only the par value. This is a bit of review from last class. So when we issue stock, or when we sell stock, we know that we're going to split the value when we have a par or stated value. That par or stated value needs to go in the common stock account for every issued share. But on the day that we declare these dividends, we haven't yet distributed the stock, and so or issued the stock. And so we cannot put that par value into the common stock account because those shares haven't yet been issued. So we use a kind of a holding account. It's similar to a payable in that we're saying we're going to do something with this later. You'll notice the term there is distributable. So this $15 par value per share times the 110,000 shares that we are going to distribute that represents the par value that when we issue these shares, we will move that into the common stock account. It is a stockholders' equity account. It belongs with the contributed capital, but it is a holding account, as I said, until we actually distribute those shares. Now, as we saw last class, when we sell stock, anything over and above the par value, so in this case, it's the difference from $15 par value up to the $18 market value, so $3 per share times 110,000 shares, $330,000. You'll notice that's the difference between the total value of the stock dividend and the amount that's considered the par value. So it is okay for us to put that other, the excess $330,000 directly into the paid-in capital account. It's okay to do that now. We can't put it into the common stock account, the par value, because those shares have not yet been issued. But if we look at the next step here for A2, says, okay, now we're going to issue those stock certificates. We're actually going to issue the stock. And at that point, it's no longer distributable. It's been distributed or been issued, and we can move the par value into the common stock account. Not when the dividend is declared, but when it's actually issued. And so it's a two-step process. Just like the three important dates that we saw in exercise 5 last class. The first entry here is the declaration date, where it becomes an obligation of the company. And the second entry here is the date those shares are actually issued. Any questions about that? So let me scroll down here. We already know, we already talked about, and I explained using the accounting equation, that our total stockholders' equity is unaffected by this stock dividend. So what was our total stockholders' equity before the stock dividend? We had 33 million in par value sitting in the common stock account. We had 9 million in excess of par. And then we had retained earnings of $89,550, $550,000, excuse me. The reason that, in case you are wondering, this last sentence, which I had not yet read out loud, the reason that they tell us that there's no income or loss for the current year isn't because that's highly likely, but because it means that our equity wasn't impacted. So they've just made that simplifying assumption for us. So they've just made that simplifying assumption for us. Our retained earnings was $89,550. And the total paid in capital was 33 plus 9, 42 million. So that's based on the numbers that were given to us. The only math we had to do was adding together the two paid in capital accounts and then adding that to the retained earnings. So what happened when we actually issued this stock dividend? We already know that the total equity remains unchanged. But because it's a small stock dividend, we moved the fair market value of $18 per share out of retained earnings and into contributed or paid in capital. So the total value, $18 per share times the 110,000 shares we were going to issue, the total value is right here, 1,980,000. We're going to add that to the paid in capital and subtract it from the retained earnings. Again, the totals remain the same. That must be the case because our assets and liabilities were unaffected by this. But what changed is an increase in our paid-in capital based on the market value of the stock at the time the dividend was declared, and a decrease to our retained earnings. As I said, if this was a large stock dividend, up anything 25% up to 100%, instead of using the $18, we would have used just the par value, and we would have moved all of that into the common stock account. There would be no paid-in capital in excess of par. So same impact though, we would move value out of retained earnings into paid-in capital. But because we assume that the market price is going to be more affected by those higher percentages, we only use the par or stated value. Any questions at this point? Everybody feel okay about this? Let me go back to our PowerPoint then. Oops. Okay. And so we just saw the use of that stock dividends distributable, and we house the par value in that account until the stock is actually distributed and at that or issued. And at that point, we move it into the common stock account. At the end of the month that we declare the dividend, we have to close that stock dividends account. Just like a cash dividend, that stock dividend on our balance sheet is moved out of retained earnings. So that is closed out of retained earnings. As we already pointed out, a stock dividend doesn't change the assets, liabilities, or the total equity. It also doesn't change the value for any individual investor. Yes, you have 10, if it's a 10% dividend, you have 10% more shares, but so does everyone else. And so your proportional ownership of the company hasn't changed. So as I said, we didn't really create any value for the stockholder except that psychological impact of sending a positive signal that we believe in the company, we believe the company will continue to be successful, we want to give you something of value, and we believe these shares have value. As I said, we'll talk about a stock split next. So as I said, a stock split is, the purpose really is to lower the price of that stock so that it gets it into that ideal trading range or keeps it in that ideal trading range. The assumption is that the stock price has hit that ceiling. It's going to stop increasing in value. And by lowering the price, we allow that price increase to go, continue happening. So on our balance sheet then, or on our books, when we affect a stock split, we don't do anything that we just talked about in the previous exercise. We do not move any value out of retained earnings and into contributed capital. All of the dollar amounts stay exactly where they were in the accounts where they were. What would happen is we would change the par or stated value of the existing shares. So remember, we said the common stock account must have in it the number of issued shares times the par value. So if we do a 100% stock split, so if you had one share, now you have two, the only way that can stay true, that the common stock account has in it all of the par value for all of the issued shares, the only way that can stay true is if we change the par value. And so for a 100% stock split, we now have twice as many shares, but the par value for each one is cut in half. And so here's your example. In this case, it was a 5-to-1 stock split. And so if there were 4 shares outstanding before, now there are 20 shares. If it had a $100 par value before the split, it now has a $20 par value. So you had 1 share, now you have 5, but each one is worth 1/5 the amount that it was before. So again, your ownership stake in the company hasn't really changed. You still own, if you had 1 of the shares before, God bless you, you still own 1/4 of the company. But it's just 5 out of the 20 instead of 1 out of the 4. In reality, when stock splits happen, and stock splits are much more likely to be 2 or maybe 3-to-1 rather than 5-to-1. But when stock splits do happen, we do see the price change exactly how you would expect it to change. If there are twice as many shares outstanding, the price will be cut in half on the open market. But we do see it start to climb again right after that stock split. So there may be something to this, the thought of the psychology behind a stock split. So stock splits don't require a journal entry because nothing has changed within the individual accounts, but there would be normally a note to the or disclosure because it does change the par value and the number of shares. Oh, we need to go to our next exercise. Exercise 7 is related to stock splits and dividend transactions. So exercise 7 next. Selected transactions completed by Canyon Ferry Boating Corporation during the current fiscal year are as follows. We're asked to journalize the entry and put no entry required if there's no entry required. If an amount box does not require an entry, we can leave it blank. So on January 8th, we split the common stock 2-for-1, and we cut the par value from 100 to 50 shares, or $50 per share, excuse me. After the split, there were 300,000 common shares outstanding. So how many were there before? 150,000. As we just discussed, a stock split does not require a journal entry at all. Nothing changed except we now have twice as many shares, but they each have half the par value as they had before the split. So no entry required there. So before the split, we had 150,000 shares outstanding. After the split, we have 300,000. On April 30th, we declared dividends on both the preferred and the common stock. Let me get my annotate up here. So let's figure out what the total value of that was. There are 16,000 shares of preferred stock outstanding, and each of those is going to receive 60 cents in dividends for a total of $9,600. We are told that after the split, we have 300,000 common shares outstanding, and each of those is going to receive 22 cents. Whoops. For $66,000. So we just need to add those two pieces together to find out the total cash dividends. Whoops. So if you're wondering why did they do a stock dividend, a stock split on January 8th, and then they paid cash dividends, remember the purpose of a stock split is to lower the market value. And so these are not inconsistent that we might then a few months later declare dividends. So thinking back to what we did in exercise 5 last time, when we declare the dividends, that's the first important date, and it does require a journal entry. When we declare the dividend, we have to both report the value of that dividend. That's the amount that we're going to remove from retained earnings when we close our books. And we have to set up the liability. At the moment the dividends are declared by the board of directors, they become a legal liability of the corporation. And so we need to get it on our books. And so when we close our books at the end of April, we will show a liability of $75,600 on our balance sheet. And our retained earnings will have gone down by $75,600 due to the impact of this cost. And not an expense because it didn't help us to make any money, but the cost. The next important date would happen sometime after the declaration date, but before July 1st, when it says we paid the cash dividends. So the next important date is the date of record, and that determines who will receive the dividends. Whoever owns the stock on that date of record will receive the dividends, even if they sell the stock prior to July 1st. Now we move ahead to the third important date, which is the payment date. And they're actually going to pay these dividends. So we're going to remove the liability from our balance sheet. We don't owe that anymore because we're actually paying it. And so what do we use to pay it? Cash. Okay. I'm going to erase that and scroll down. And so we had 16,000 shares of preferred stock and 300,000 shares of common stock. On October 31st, we declared the other half. These are semi-annual dividends. That means they get paid every 6 months or twice a year. And so we're going to declare the dividend, the remaining dividend on the preferred stock, excuse me, 16,000 shares at 60 cents per share. That's the $9,600. We had included that up here with the cash dividends on the common stock. Whoops, sorry, I got ahead of myself. There's also another dividend on the common stock, but it's not the full 22 cents that they paid last time. I'm gonna have to change this number. I read ahead to the common stock dividend and thought that's all we were doing. So we have 300,000 shares of common stock outstanding. We need to include that here as well. 300,000 shares at 11 cents per share. That's $33,000 plus the dividend for the preferred stock. Now I have my total. I apologize for that. So they only paid the second time around, they only paid half as much to the common stockholders. Rather than paying 22 cents, they now only paid 11 cents. Why would they do that, you might ask? Well, one reason might be because maybe they don't have the cash available to pay the full 22-cent dividend. They're not required to pay any dividends. And so the board of directors might look at that and say, well, 11 cents is better than nothing, but we also don't want to send a negative signal to the market. We don't want people to look at that 11 cents and say, boy, the company must not be doing very well. They always pay 22 cents and now they only paid 11 cents. And so that might be the reason for this. That in addition to the 11-cent cash dividend, we also declared a stock dividend of 5%. It's a small stock dividend. So there were 300,000 shares outstanding. We declared a 5% stock dividend. And that would be 15,000 additional shares to be distributed. Because it's a small stock dividend, less than 25%, we can use the fair market value. The market value of those shares at the time the dividend was declared was $56. I don't know why it says it's estimated to be $56. If there's a liquid market for these shares, they should be able to just look that up. So $56 per share. And so the value that we are going to use to record this dividend is $840,000. That is the, oops. So we need to put in the accounts for October 31st. Those accounts are going to mirror what we did back here on April 30th when the last cash dividend was declared. We report the value or the cost of that. That's going to come out of retained earnings. And we set up the liability. Now we have to pay for it. But the other part of this is the stock dividend. So again, we have to report the value of that, which we just calculated to be $840,000. And we need to set up the common stock distributable, stock dividends distributable, $15,000. What was the par value? Okay, right up here. Had to go back up to find that. So on January 8th, when we split the stock, the par value went to $50 per share. And so $50 per share times the 15,000 shares that we're going to issue would be $750,000. And the rest, I apologize that I've got now that green writing in the middle there. The rest, the other 90,000 is paid in capital in excess of par. Everyone okay with how we did that? We used the fair market value per share because it's a small stock dividend. And we set this up as being distributable for the par value. And now on December 31st, we're actually going to pay the cash dividends and distribute that stock dividend. So the first part of the entry, again, looks just like we did here on July 1st when we paid the cash dividends. We take the liability off our balance sheet and we mail out the checks. But at the same time, we're issuing those other 15,000 shares. And so that common stock that was distributable has now been distributed. And so we can move that out of distributable into the common stock account. That's the par value. And so the end result of both the cash and the stock dividends is to reduce retained earnings. For the cash dividend, obviously, we also reduce our cash. But for the stock dividend, we reduce retained earnings, but move that value into the paid in or contributed capital. So we've now covered cash dividends, stock splits. Any questions on any of that? All righty. Let's go back to our PowerPoint then. I have made mention of treasury stock a couple times, but we're actually going to get into that, and our next exercise is going to be related to treasury stock transactions. So what is treasury stock? It is stock that a company has issued, but then for some reason has repurchased. So it was issued, but it's no longer outstanding. So those three amounts we talked about last class, authorized, issued, and outstanding, we said that the number of issued shares can't be higher than the authorization, and the number of outstanding shares can't be higher than the number that are issued. The difference between the shares that we issued, that number, and the number of shares that are outstanding is the treasury stock. You can see some examples on the screen for why a company might decide to buy back its own stock. So we talked about in a previous class the issue, it's called, let me put this on the screen to remind you, It's called the principal agent problem. One of the issues with the corporate form of organization is the double taxation of corporate profits. We've talked about that. But in that same context, we talked about another problem, which is the owners of the company are not the managers of the company. And so we need to somehow align the incentives. We want the managers of the company to want to make money for the owners of the company, not just for themselves. And one way we can do that is to make the managers owners. And we can do that a couple of different ways. We can give them stock in the company, or we can allow them to buy it at a reduced price. And so when you see one of the reasons here to reissue as bonuses to employees, they're really with that trying to address this principal agent problem, to make the employees owners of the company, and so that they more closely recognize that acting in behalf, that they're acting on behalf of the owners now themselves. And if the company does well, they will also do well. We talked about one of the purposes of stock dividends and certainly stock splits is to lower the price of stock. The opposite is true. If we want to raise the price of the stock, how do we do that? From a strictly economic standpoint, if there are fewer shares out there, the price should go up. And so if the company sees that the price of their stock is sagging, one way they can support that is by repurchasing their own stock, taking some out of circulation. There's nothing unethical or inappropriate about that either. I don't want to mislead you. So our next exercise is going to be related to treasury stock. You've seen a few of the main reasons that companies might decide to repurchase its own stock. I think we mentioned in class last week what's going on with Twitter and Elon Musk. That's another reason, that's a potential reason that a company might repurchase some of its own stock, is to prevent someone else from buying it. And that's exactly what may have been happening with Twitter last week. The company may have been, they may have been repurchasing its own stock to keep Elon Musk from buying it. Our exercise, though, is focused, of course, not on the why a company would repurchase their own stock as treasury stock, but how do we report that or record it in our accounting records? And so that's what we're going to be doing next. The method that we are going to be using for reporting treasury stock transactions is known as the cost method. And so we are going to use a separate account for that treasury stock. The treasury stock has a normal debit balance. It is an offset or a reduction to our equity. It has a debit balance. It appears on our balance sheet in the equity section, but it's a reduction or an offset. It's usually shown as a negative number to remind us or to demonstrate, hey, this means less equity. So any transaction that we do in that treasury stock account, we're going to report based on how much we paid for the stock when we repurchased it on the open market. Just as a reminder, we only pay dividends on the shares that are outstanding. Treasury stock is considered still issued, but no longer outstanding. So if we declare dividends, those dividends are not for the treasury shares. They're only for the shares that are still in the hands of the public. So let's go to our next exercise, exercise 8. Any questions about what I just said? I don't know if I can get this all on the screen or not. No, okay, let's just keep it there then. Spray Company Incorporated develops and produces spraying equipment for lawn maintenance and industrial uses. On March 9th of the current year, Spray Company reacquired 62,000 shares of its own common stock at $51 per share. On June 9th, then they sold some of those shares, and then on November 13th, they sold some additional shares. So I think one way for us to see this clearly is if I put a T account here on the screen. Hopefully this is out of our way. So I'm going to put a T account on the screen for our treasury shares. Change that to black, I think. And just as a reminder, treasury stock is considered an equity account, but it's an offset to our equity. So I'm going to show that it has a normal debit balance. That we're going to increase that account on the debit side and decrease it on the credit side. So the first thing that happened is we bought some of our own shares back. How do we do that? The same way you or I would do that. If we wanted shares in Spray Company Incorporated, we contact a broker and say, hey, buy us some shares. And that's exactly what happened here. Spray Company went out on the open market and repurchased 62,000 shares of its own stock at $51 per share. 62,000 shares at $51 per share. The total price is $3,162,000. That represents the treasury stock. And what did we use to buy it? Cash. So what happened here? We increased our treasury stock account by $3,162,000. That increase to treasury stock decreases our total equity. Our assets went down by $3 million because we spent the cash, and our equity went down by the same $3 million. So we're still in balance. We have less cash, but we also have less equity. Again, this exercise doesn't tell us why they bought back those shares, but we already saw some of the reasons. Maybe the reason is so we can give those shares to our employees or sell them to our employees at a reduced price. And that's fine. We didn't do anything wrong. There's no intent to defraud here. It is a very typical transaction. Not that companies buy back their own stock every day, but it's not uncommon to have that happen. Because remember, in order to issue the shares, they have to have them available to issue. And so if they've run out of room in their authorization, they can go back and get permission to sell more, but that's a complicated legal process. It might be easier just if they have the cash to go out and buy them back themselves. And now they have those shares they can do with what they will. Any questions so far? So remember, we're using the cost method. And so in this treasury stock account, I'm just going to put a note here to remind us, everything that goes in or out of that account is going to be at the price we paid for those shares, which is $51 per share. So on June 9th, when we resold some of those shares, we sold them at $60 per share. You might think of that as, ooh, we made some money. We paid $51 for them. We sold them for $60. We made some money. But we don't get to report on our income statement that we made money by selling our own stock. That's not how this works. And so, yes, we have the cash. Let's see how much cash. So I can put that here in my treasury stock account. We sold 48,000 shares at $60 a share. That's $2,880,000. Don't put that on if you're making notes. Don't put that on your notes yet. So $2,880,000 is the cash we realized. But remember, the treasury stock account, the stock that's in there has a value of $51 per share. So in that treasury stock account, We only want to take out those shares at $51 per share at cost, at what we paid for them. 48,000 shares at $51 per share is only 2,448,000. So that's the amount we're going to take out of the treasury stock account, because everything gets reported in that account at cost. Our cost is $51. But as I already pointed out, we sold them for $60 a share. That's definitely how much extra additional cash we got for them. So the cash account has to show what we actually received for them. Remember, we never adjust cash. We either have it or we don't. If we have it, we need to report it. But the treasury stock account has to be reported at the $51 because we use the cost method. So what's the difference here? Oops. $432,000. $432,000 represents, it's tempting to think of that as the amount we made on this sale. But again, it does not get reported on our income statement. We don't get to report making money by selling our own stock. Instead, it gets reported on the balance sheet. Paid in capital from sale of treasury stock. It gets reported on the balance sheet, not on the income statement. It is an equity account. Okay. The next transaction is November 13th, and we sell some additional shares. So remember, we started out with 62,000 shares. We just sold 48,000 of them on June 9th. And so that left us with 14,000 shares. Now we're going to sell another 7,500 shares. And that leaves us with 6,500 in our treasury stock. We're going to account for this in exactly the same way. Cash will be the amount we actually sold them for, $54 a share. Treasury stock to remove from our treasury stock at $51 per share at cost. And then the extra $3 will go into paid in capital from the sale of the treasury stock. So $54 per share for 7,500 shares is the cash. But we only want to take it out of the treasury stock account at $51 per share at cost, at our cost. And then the difference, the other $3 per share, to make this entry balance 22,500. Any question about recording those transactions? Again, the key piece of information is that once we put those shares in here at $51 per share, we have to take them out at $51 per share. And that we do not record an income or a gain from selling our own stock. We never get to do that. We saw in the last chapter that we do record gains or losses related to bonds, bond transactions, bonds that we retire early. We do not do that for selling our own stock. So our last questions here, what is the balance in the paid in capital? at the end of the year. So we had 2 entries to the paid-in capital right there. Both credits, 432,000 plus 22,500 would be the balance. And that would be a credit balance because both of those were credits to the paid-in capital account. What's the balance in the treasury stock account? Well, we have all that we need here to find that balance. Add up the debits, there's only one. Add up the credits, subtract the smaller number from the larger number. The debits, the debit footing was larger than the credit footing, so this account would have a debit balance. Can the treasury stock account ever have a credit balance? Not when we use the cost method. It can have a 0 balance if we've sold all of those shares, but it cannot have a credit balance. How will the balance in the treasury stock be reported on the balance sheet? It is reported in the equity section, but it's a deduction. It reduces our total equity. And as I suggested, we normally do show it as with a negative sign, symbol indicating that it is a negative. Okay. So we've talked about why a company might repurchase its own stock, and we've seen how those treasury stock transactions get reported on in our accounting records at cost. The paid-in capital account, in case you're wondering, the paid-in capital account is also an equity account, and it would show up in the contributed capital section of the equity statement, of the equity section of the balance sheet. Any questions before I keep going? Okay. So let me go back. Let me go back to our PowerPoint. And our next topic is the equity section of the balance sheet. And our next exercise is going to be to put together an equity section of the balance sheet. So starting in chapter 1, we knew what the balance sheet was, but up to this chapter, we've had only 2 accounts showing up in the equity section. We had contributed capital as common stock, and then we had the retained earnings. So it is now the case that we know many other accounts that might go in that equity section. A company could have preferred stock. They could have an excess capital on the preferred stock. They could have common stock and have excess capital on that. We've now seen that they can have paid-in capital on the treasury stock. Then we have retained earnings, and then we have treasury stock. So as you can see that there are 2 different methods of reporting this. And the difference is what we do with that excess paid-in capital. Do we lump it all together, or do we keep it separate? One with the preferred stock, one with the common stock, and then potentially one for any treasury stock paid-in capital. So here you can see examples of each method. So method 1, we keep the paid-in capital separate for preferred, for common, and then for the treasury stock. You'll notice the treasury stock is reported down here at the bottom. We show it as a negative. It reduces our total equity. In method 2, we have just one line for additional paid-in capital. Now, again, you'll notice the totals are the same, but it's just whether we separate that paid-in capital for the preferred, the common, and potentially treasury stock, or do we report it as just one line item as we do down here, the additional paid-in capital. Within the paid-in capital, if we have preferred stock, it is always going to be listed before the common stock. You'll also notice that we have to disclose to the the user of these financial statements some additional information about our stock. And so this is really the first time we're seeing that we have to say if there's a par value or a stated value. We have to say how many shares have been authorized and issued and outstanding. Okay, so that's a required disclosure. Okay, let's go to our next exercise then. Moving right along. So our next exercise is to put together the stockholders' equity section of the balance sheet. Now we are showing this as if it's kind of like it's a separate statement, but we're really just focusing in on the one section of the balance sheet. We would not have this as a separate financial statement. It's only a portion of the balance sheet. We're asked to use method 1. And so remember on the example we just looked at, method 1 had us list the paid in capital in excess of par, or the additional paid in capital, separately for the preferred, for the common, and then potentially for any treasury stock. So we know that in the equity section, we're going to always start with the preferred stock if we have any. So let's do that first. Oops. So here's our preferred stock. That's the par value, $150 par value. We're going to put that first. Oops. And it already has filled in for us those additional disclosures that are required. You can see that this is 1% stock. It doesn't tell us whether it's cumulative or not. That also would be a required disclosure. 1% is the stated dividend rate. We have the par value. We know how many shares are authorized and how many shares have been issued. We then have any excess or additional paid in capital for the preferred stock. In this case, it's $384,000. Then we have a total for our preferred stock. And we do the same thing for the common stock under method 1, where we have the par value. Then we give the additional paid in capital for the common stock, and then we'll have the total for the common stock. So go ahead and fill those numbers in from what's given in the exercise. Oops. And then the total for your common stock. Since Specialty Auto Racing does have some treasury stock, we also have paid in capital from that treasury stock. And so that's going to be our next line. And that is our, oh, I just is rolling off the edge. Like, all right, I'm just going to collapse that to me. So these aren't too small. So that now we have all of our contributed or paid in capital. And so we can add together the preferred, the common, and then the treasury stock paid in capital. So go ahead and do that. Once we have our paid in capital, the next account that would be listed would be the retained earnings. And that will give us our total capital. Yes, sir. Did I do something?
From sale of treasury stock, it's $340,000.
Oh, thank you. Yep. I have a copy error here. That should be 340,000. So I'll need to update this. And this, thank you for pointing that out. I just copied it wrong from the top of the problem. Thank you. Okay, then the very last step, because this company does have some treasury stock still, here's our treasury stock of 1,008,000. That would be at cost. And as we know, that is a reduction or an offset. So we're going to show that as a negative. It's not wrong not to put the negative in there, but it does help us remember that, oh, we have to subtract that. That outstanding, not outstanding, that treasury stock that we have repurchased and have not yet sold, the treasury stock that we still have, reduces our equity. Now, those are still considered issued shares. So when we look up here at the common stock account, those 24,000 shares of treasury stock are included, I can't highlight that, are included in this 280,000 shares that are issued. They're still considered issued, but they're no longer outstanding. Those treasury shares, as we already pointed out, would not receive dividends. Those treasury shares do not get to vote. They're not considered outstanding. Any questions about, so this is what would appear on the equity section for this company at the end of July. The other method, method 2 in our description, would have simply taken this 384 plus the 420 for the common stock and the 340 for the treasury stock, added those all together and just shown them as one line item, additional paid in capital. Doing really well on time, I'm pleased to see. We have just one more exercise related to the statement of stockholders' equity. Any questions though before we move on to our final exercise? So back in chapter 1, we said that there are 4 financial statements that all companies are required to share, to present in their annual report and to have audited. And one of those is the statement of stockholders' equity. So we've spent considerable time this semester so far talking about the income statement, and most of our time probably, if we were to break it down by day, most of our time has been really looking at the balance sheet and the different components that make up the balance sheet. What we're looking at in our final exercise is the stockholders' equity statement. Now, we have been looking at this since chapter 1, but up to this point, we really only had common stock and retained earnings, and now we have all these other, potentially have all these other accounts that might appear in our equity section, and therefore might be included or would be included on our statement of stockholders' equity. Let me change pages. Okay. So let me just jump ahead here. So it could be that if a company doesn't really have any changes to their contributed capital, that they decide to do a retained earnings statement just to show what happened with that. And so this is an example of a retained earnings statement. Either way, we start with the beginning balance. We're working toward the ending balance that's going to show up on the balance sheet, and we show what happened for the changes. And we've known again since chapter 1, the main things that can change our retained earnings is the company makes or loses money. We see that here. And the company may pay dividends. So dividends would reduce our equity, income would increase our equity, of course. This is what I'm looking for next. So there we go. For that same company, we just saw what the retained earnings statement would look like. It's really just the information in this column. Excuse me. The statement of stockholders' equity has a column for every item that would appear on their balance sheet in the equity section. We start with what was the balance at the beginning of the year. We end with what was the balance at the end of the period, in this case, the year. And then everything in between shows what else changed, what else happened during the period that affected that account. So again, we start with the beginning balances, we show any change to those balances, and then we end with the ending balances. And that's what we're going to do in our final exercise for this chapter. So what we have in this exercise, in exercise 10, are some T accounts for common stock, paid in capital of in excess of par, treasury stock, retained earnings. Our job then is to create the statement of stockholders' equity, to take the information that's included here and show what it would look like. So we start with our beginning balances, and those are going to be given to us. So for common stock, the beginning balance was $4,800,000. Oops. What happened to the common stock account during the year? It increased. Why did it increase? Because we sold some new stock. You can see a credit to this account for 1.2 million. And if we look down here in the paid in capital in excess of par, the additional paid in capital account for the common stock, we know that we sold it for more than its par value. The par value, 1.2 million, was added to the common stock account, and the rest, the other 300,000, was added to the additional paid in capital account. In other words, we sold the stock for $1.5 million. What we don't see here is that our cash would also have increased by 1.5 million. I want you to keep in mind, of course, we can't have these credits without a corresponding debit. That debit would have been to cash if we sold these shares. So the beginning balance in paid in capital in excess of par was $960,000. And we know that on April 14th, we sold $1.5 million more in shares. We put the par value into the common stock account, $40 per share. And then we put the excess or the additional into the paid in capital in excess of par. Now we can tell, because we can see the T accounts here, nothing else happened in those two accounts. And so we can go ahead and enter our ending balances for those. We can also tell because we have a template provided for us, and we can see nothing else changed there. These ending balances then are going to be what we use on the balance sheet. The next account is treasury stock. You'll notice there was no beginning balance. And so last year's statement of stockholders' equity wouldn't have had a column for treasury stock. We didn't have any treasury stock at that time. But during the year, we can see right here, we bought 12,000 shares of our own stock. Now, I'm not suggesting that it would be normal for us to sell 30,000 shares on April 14th and then buy 12,000 of them back in August. That probably wouldn't have happened. But as usual, we're looking at an example here so that we can see what would it look like. But I'm not trying to suggest that this would have actually happened. We're going to show the treasury stock as a negative number to remind us that that decreases our equity. And again, that's the only thing that happened in that account during the year. So we're showing that as a negative number. It has a debit balance. And so we're showing that as a negative number. Our last account then that we have to address is the retained earnings. And I have this set so it's exactly at the top of the screen so we can see what we need. The beginning balance was $11,375,000. We know that there are two main transactions that affect retained earnings during the year. We might make money, and that's what we see here with the increase or the credit right here. We had a net income. If that had been a debit, it would have been a net loss. We'd show that as a negative. Now it appears that this company paid dividends quarterly. We can see 4 separate entries, end of March, June, September, and December. For the purposes of this statement, we can just lump all those together. So it paid $69,000 in dividends 4 times, a total of $276,000. And it's okay to lump those together. We do not need to have a separate entry for each time they paid dividends. Even if they weren't the same every time, it's okay to just show the dividends. If there were cash dividends and stock dividends, we would probably show those separately, even though both would affect our retained earnings. We would probably have 2 separate lines for those. Again, we already know our ending balance because it's given there in the T account. But if that was not given, we could have found that by starting with our beginning balance, adding the income, subtracting the dividends. And to finish up this exercise, we simply need to add across to get the totals. Oops. And then for the final row, you can either add across or add down. You should get the same, better get the same answer either way. And so when we look at this company's balance sheet, what we would see in the equity section is right here. We see the beginning balances because it's the end of last year. And we know we have to prepare comparative financial statements so we can see at least 2 years worth of data. So you can see what were at the beginning of the year, what were they at the end of the year. That shows up on the balance sheet. And someone who's wondering, well, what happened? Why did those numbers change? Can come to the statement of stockholders' equity to see more information about why did the common stock, for example, increase from 4.8 to $6 million. Glad to see I added correctly. Any questions about the statement of stockholders' equity? So it really just shows what happened over the period of time. So just like the income statement, the third line of the heading shows the range of dates. We're showing what happened during the year from January 1st to December 31st. I have just a couple more things I want to say related to this chapter. I want you to make sure you read the last part of the chapter. As has been the case in earlier chapters, we aren't in the individual chapters, we haven't been looking at the financial statement analysis type calculations. Our final chapter for the semester is chapter 14, and we're going to be looking at all of these. But the book does, in this chapter, talk about some ways of analyzing information related to our stock. Earnings per share. So you can see the calculation there. There's a typo there. Preferred should have 2 R's there together. So we'll be looking at earnings per share in chapter 14, but it's a way of evaluating really what does the market think about this company. A high earnings per share is usually a company that's been around for a while. It is a company that's already making money. A low earnings per share is going to be a company that maybe that's a startup or maybe toward the end of its life. But you can evaluate how well this company is using the money that you've invested in it or potentially investing in it. So you're looking for a high earnings per share, generally meaning a successful company. Oh, hang on, I thought there was one other thing I wanted to talk about. Oh, I think that was it right there. So, oops. So one other thing I wanted to just mention, again, you should read about this in the book. When you're talking about the company's financial statements, you may see additional information about restrictions on specifically on their retained earnings, requirements imposed by the board of directors. So you should read about that in your textbook, and if you have any questions on that, of course, you can ask. We're not going to spend any time talking about it in class unless you have questions about it. I think it's pretty straightforward. So with just a couple minutes to spare, we have finished our discussion of chapter 12. Does anyone have any questions or anything you want to talk about? All right, well, thank you for being here. We'll end a couple minutes early today then, and on Wednesday, we will start chapter 13 on cash flow statements. Remember, if you do want to have a drop-in review session later in the week, but not Friday, please just send me an email to let me know when might work for you, and if we can, we'll schedule one. I'll let you know by announcement and in class on Wednesday if we have a time. All right, thank you for being here.